On Divorce Right, HR solutions for divorce in the workplace. And today we've got a very, very special topic for you. And the reason that I like this topic is because it's something that nobody really thinks about when going through the divorce, how important this topic is to having a family be able to move on after divorce with a wonderful place to live. And we know that retaining your employees is super, super important. And in a case of a divorce, those employees, 5% of them will quit. So we want to talk today about how we can actually help you retain your divorcing employees that normally would leave. And I want to tell you a little bit about our topic and our speaker. So today we're going to be talking about the importance of using what's called a Cdlp, a certified divorce lending professional, for your employees that are going through. Because when you have somebody like this on your team, your employee will be able to be better served, get more buying power based upon how they work with the settlement statement. So let me tell you about Stephen Rigo, and his last name may look familiar to you. He is married to the wonderful Paulette Rigo right here on the screen with him. And Stephen is originally from Boston and currently living in Georgia, just outside of Atlanta, with his wife, Paulette, one of our hosts today. In fact, through Paulette's work in divorce, Stephen discovered Divorce Lending Association and quickly decided to add the certification of Certified Divorce Lending Professional to his mortgage and advisor business. With over 30 years of real estate knowledge, from sales to construction to lending, finding the best solutions for his client is his daily motivation. When working with divorcing couples and individuals, Stephen offers a unique perspective and education to the divorce process. So welcome not only to the show, but to the family. Stephen Rigo, how are you?
Good. Thank you very much, Vicki. I'm
I'm,
well. Thank
I'm so glad. And you've got your lovely wife and our director of coaching and management, Paulette Rigo. Paulette, I'm going to let you take this over today, because I know that you know this man a little bit better than we all do. And I know that you guys worked on cases together, right? And you understand the value proposition that somebody with his education and understanding makes a difference in the outcomes for your clients.
It makes an enormous difference. And thank you for also seeing the value in this role, because I do agree with you that it is often overlooked, not only by the courts, but by attorneys, not because they mean to. It's just a mistake, and it's a pattern. And it obviously, it mostly creates a problem for the person that is looking to either figure out what to do with the house, because the couple just really is at a standstill. Much of the time, they're emotionally attached to the house. There's a lot of emotions involved in the marital home, and sometimes there's a summer place or a lake property, a ski property. It's not always just one home. Normally, it's that marital home. And I didn't know, but 86% of divorce involves a sale or purchase of real estate. So then, of course, when you're talking about real estate, you are talking about lending and mortgages. So yes, I am extremely familiar with this young man that shares my name with. Actually, I share his name, but who would have thought I'd get remarried? But I did. And so Stephen is my husband. Yes, he is the certified divorce lending professional. And most people say, wait, he's a what? What's a Cdlp? So Stephen, what is a Cdlp?
Well, as Vicki mentioned, I found the Divorce Lending Association through you when our offices are down the hall from each other, and she yelled down, "Hey, did you ever hear of the Divorce Lending Association and the Cdlp?" And I hadn't, and quickly quick Google and found this amazing organization that Jody Bruns had founded, a longtime mortgage professional who was a little frustrated with the process when somebody would come to her, for instance, and say, "Hey, I just got divorced and I want to buy a house," only to find that the settlement agreement in their divorce, or the divorce decree, did not set them up for qualifying for a mortgage. And she thought, if you had only talked to me a couple of months sooner, I could have made a few tweaks and you could have rolled right into a mortgage qualification from your divorce. So that was her motivation. And I picked up the phone. I got to know Jody, she's an amazing person. And her mission is to be part of the solution team when people go through divorce, not specifically, I need to hire an attorney and they're going to handle everything. A lot of attorneys and judges make decisions regarding the marital home without ever consulting or being aware of mortgage guidelines and qualifications. So it's been an amazing experience, and I learned so much that I never knew. Nobody teaches you this stuff. And the Cdlp community is growing. We still have a long way to go, but word is getting out. Fellow members I know are working directly with mediators, attorneys, collaborative law professionals, and we like to be part of that solution team, whether it's financial planners, parenting experts. The mortgage piece is a valuable piece, and we have the expertise to really just find the best solution for both parties.
And if I could just interject, it's not about anybody doing a bad job as much as it's just, family law attorneys are there for the law piece. They don't know how and what is necessary to get a mortgage. So this is not a slight against a family law attorney, other than to say they need the support of those experts that do know what they're talking about. And in this case, and this is why I've always felt very strongly that a mortgage broker or mortgage agent should absolutely be in the room at the beginning of all of this, so that we can get everybody on the right track to be able to have access to being able to be a homeowner again.
Mm-hmm. Yes. I mean, with the work I do as a certified divorce coach and as a mediator, I bring Stephen in with my clientele immediately. If I know there's a marital home and there's a mortgage, and they don't know what to do, which most of them don't, the more education they have, the better. So it makes an incredible difference in the success of the mediation and their experience they have, because they don't feel so much anxiety about what to do, and they know their options. So Stephen, how do you specifically help couples and individuals in divorce? So now that we know what a CDLP is, how do you help them?
Well, I think you brought up the correct term, is education. So when you bring me in, for example, to speak to a couple who's going through a divorce, it's really educating them on mortgage guidelines, different from when they purchased the house, different from when they may have refinanced. Much like the financial world, there are specific guidelines as it relates to divorce, which are actually beneficial in cases of divorce. For instance, most of us are familiar with the Quadro, the Qualified Domestic Relations Order, where assets can be divided like a 401k, an IRA, without tax penalty or without other penalties incurred because it is due to divorce. It's essentially court ordered. The same holds true for mortgages. So let's say there's going to be a refinance and one spouse will retain the home. There's specific guidelines when it comes to divorce. It's not treated as what we call a rate and term, a cash out refinance, but it is essentially a rate and term. I know that's mortgage speak, but it changes the guidelines and the limitations on how much cash can be pulled from the equity and so forth. So those kinds of things, it's really about education and getting to know the end goal. Does one spouse really want to stay in the house? Is that the best option for them? What are the tax implications? Is there going to be capital gains involved? We rely on a financial planner and work together as a team to say, okay, can the equity in the home be part of the marital picture so that we're going to divide those assets equitably, and the mortgage piece is not its own separate thing, but part of the overall solution.
So taking into a specific scenarios, perhaps, hundreds of them going through my head, but what are the most common mistakes and errors that you see working with divorcing individuals and couples when making decisions regarding the marital home?
Well, again, if one spouse wants to stay in the house, the misconception is that it's going to be a refinance, or there's going to be a change of names on the title and maybe on the mortgage, but really it's going to be a new mortgage. It has to be. So if, let's say, one spouse is on the mortgage and the other is not, but both are on title, in order to create a new mortgage and release that party from the title, then it's going to be, it's a refinance, but essentially a new mortgage. And the part of that new mortgage can include the title work and any equity cash that we're going to take out to satisfy the distribution of assets.
I often get the comment, well, can't you just take her name off or take his name off, right? Like, why can't we just get out what's that called, whiteout, and scratch it off? And they have this conception
of Sharpie. Take it out with a Sharpie.
Can we just keep it and just cross the person's name out? And I'm gathering from your comment that isn't allowed, legal. That's true?
That's true. An assumption of a mortgage is possible in some instances, but more likely than not, it will take a new mortgage. And as a Cdlp, we follow the process from the initial application or the first evaluation and consultation all the way to closing, because the title piece at the end. So we're going from the application to the closing table. Through the whole process, we're involved and make sure everything is taken care of, especially the title piece, because in Georgia, it's a quick claim deed to remove one party from the deed, and the other spouse would stay on the deed, but essentially the deed is rewritten and part of that new mortgage piece. So the lender's going to want to see that too. They need to see what the picture looks like from start to finish. We don't hand off the loan to anybody. We don't move it up the ladder. It's not taken over by anyone else. The Cdlp follows the loan, or through the applicants, through the whole process. And along the way, we're in constant communication with the mediator, with the divorce attorney, with the financial planners, so make sure everybody's on the same page, because the last thing we want to do is get to the closing table and have surprises.
The last thing anyone wants in divorce are surprises. We like. So that leads to, like, what specifically is an equity buyout? What happens in that? How does that work?
So the equity in the home is the value of the home minus the outstanding balance on the home. So it's the appraised value. It's not a market value. It's the appraised value and the current mortgage balance. So the difference between that is the equity in the home. So an equitable distribution of the equity would be 50%. So let's say there's $90,000 in equity in the home, and after expenses, probably $40,000 each to each party. So when we do a refinance, again, I talked about a rate and term, we can go up to 95% of the appraised value, when in a typical refinance, you can only go up to 80%. So if, let's say, a couple wanted to do an equity buyout and they approached a lender who's maybe not as educated in the divorce process as they could be, they look at that 80% equity and say, well, we don't have enough equity to do a cash out refinance. You're probably going to have to sell the house. Now, that's a major difference, and I've had specific cases referred to me that one lender has told them they're going to have to sell the house because there was not enough equity, when in fact, even on FHA, we can go up to 96.5% of the appraised value.
And can I'd like I'd like to just remind everybody that as you're listening to this, this is one of the biggest reasons divorcing employees quit, because they can't afford to stay near their work. So
Mhm.
that's why this is really important. This is a really important conversation, because if your employees can no longer afford to stay in their home or one in the area of, of the office, that's a problem. That's why that's the one of the top 3 reasons that employees quit after a divorce. This is one of them. This is employee retention related. So remember how important it is to help your employee get to the right lender. So you see the difference here, right? Somebody thought that you had to have 80%, 20% equity. And Stephen is here to say, no, there are other options for that family. So
Mhm.
I thank you for bringing that up, because I think that was super, super important to this conversation, particularly for those that are trying to retain their good employees, for sure.
And for the spouse that retains the home, they're able to do that equity buyout so that they now have the house free and clear in their own name and can get that clean break that they're desiring. But also, Stephen, when the person that does not retain the home and now needs to start to create their new trajectory of where they're going to live and how they're going to afford it. Walk us through some tips they're going to need to know of what their credit score needs to be, some, how much money they might need, what percentage to put down. And they tend to be that spouse that really has had no experience in buying a home, financing a home. And now they're thrown into this world of, wait, I've got to buy a house, a condo, a townhouse, in rent and mortgage. And so they tend also to be a little bit nervous, anxious, fearful. And Mr. Even Steven calms them right down. But so what do you do? No, we joke, but that's his little, anyway, his nickname. So how do you hold their hand and walk them through being able to set them up for success so they have their own new property to walk and move into?
Yeah, well, the first piece of advice I would give is it's never too soon to talk to a mortgage professional about qualifying. Even if you're just contemplating divorce, most mortgage professionals love to talk mortgages. It's not a commitment. They're not looking for any money up front. All my services are free of charge. Paulette brings me in. I never charge a thing. We get paid at the end. We're commission only, and we get paid by the lender essentially. So most mortgage professionals love to talk about getting people qualified. Let's take a look at your credit, see where we are. I've had cases where a stay-at-home mom has no credit history, where one spouse took care of all the finances, nothing in her name at all. So step one, let's get a bank account in your own name. Let's get a secured credit card. Let's start building some credit. And in just a few months, she had a nice credit score and 3 trade lines, which was ideal. And that was the first hurdle to mortgage qualifying. So, like I said, it's never too early. Had she waited until after the divorce, now you have to spend all that time where you could have been doing that during the divorce process, because divorce, as you know, takes a little bit of time, 6 months, maybe a year or longer.
Well, if can I interject? I have a story. This happened. This is probably about, I'm going to guess, about a year ago or so that I was in for this. We had a woman who had been a stay-at-home mom for the longest time, and she had been married to a man. He owned the home when they were married, and it never had a mortgage on it. And at the end of their marriage, they had been married for like 17 years. Um, there was spousal support and child support. And the agreement that they made was, and it sounds good, right? This is going to sound good to everybody, I think, that listens. So this is what happened. She had agreed to not take spousal support in lieu of being able to stay at the home rent free. Right? So she could stay there. He was not going to give her her spousal support. That was a part of her rent payment. Stephen, what is wrong with that, and why couldn't she move?
Well, we need to show some history of income, Vicki. So in the cases of divorce, where a spouse maybe been out of the workforce for a while with no income, the traditional lending guidelines requires 2 years of income. In cases of divorce, we can use 6 months of income, could include alimony and child support, and 3 years of continuance. So I would recommend in her case that she start a temporary support order. So she's starting to get that alimony or the child support or both. And we get the clock started. So the clock is running. She's still in the home. She's not homeless, and the support has started. Once we have that 6 month history and we can prove that it's going to continue for 3 years, then she can file an application for a mortgage and move towards qualifying.
Right. So in this case, she would have been better off actually receiving the spousal support and paying him rent, correct?
That's
Right.
probably
Right. So,
correct. Yeah. I mean,
yeah.
I'm sure there was some negotiation available, maybe live rent free for a little while so she can catch up, maybe get some savings for, down payment.
Almost like they were going to be exchanging checks, I guess, is the way I look at it. But that's the important thing here. And that's why it's important. I think that I hope you all are starting to see bringing in the right lending professional at the beginning. And I'm talking about when you're thinking about divorce, like, how does this need to go? Because not accepting that she had to start from scratch from the moment she realized she couldn't leave. She could have been doing that all along and had the ability to move when she wanted to.
Yeah.
So it was
time is of the essence. I see it. Yeah.
Yeah.
So how is child support treated differently than alimony, Stephen, as being counted as income, or is it? Are they different? Are they the same? How are they treated?
Well, they're the same as far as income. Alimony is not taxable, and whether it's the payer or the payee, we can move things around on the application to reflect that essentially 25% of extra income due to non-taxable income. Or if someone's paying alimony, instead of having it on the debt side, we can take it off of their income side, which changes the ratio significantly sometimes. But again, it's that 6 months in that 3 years of continuance. So the age of the children matter. In Georgia, at age 18, typically child support ends. So if a child's 16 years old, we're probably only going to show 2 years of child support income, and that will not be enough. So we have to look at other solutions for that.
You talk a lot about debt to income ratio. Can you explain what that is? DTI.
Yeah, so what we do is we take all the debt the individual has, credit cards, car payments, student loans, and so forth, and the proposed new mortgage payment, including the taxes and insurance, and we divide that by the gross monthly income. And that ratio should be in the 40s. The lower the better, of course, but pretty much maxes out for most lenders around 50%. There are some programs that maybe could go high, but it's very unlikely. So the goal is to try to find a mortgage payment if we can't change some of the debt, or maybe take out some of the debt during the settlement agreement. That DTI will determine how much buying power that buyer has.
He's always got his calculator, Vicki.
I love it.
So what professionals help you help them? Do you work with other professionals as a certified divorce lending professional? And who would they be? What would they need to know?
There's some fantastic realtors who really know how to specifically work with divorcing couples. They have some great techniques to make sure everybody's on the same page. The communication is equal. It's not one-sided. And there are certifications for realtors as well as pretty much every financial professional you could think of, but fantastic realtors, mediators like yourself, Paulette, who want to work with a team that they can rely on, and of course, financial professionals. This is probably the closest because the financial planner oftentimes is the first one to find out that there could be a divorce because people want to make sure their money, their retirement reserves, and so forth are going to be safe. That's a huge concern. The marital home is probably number two. So that those two pieces of their financial picture, their retirement and the equity in the home, they're very closely related because, again, if both parties are looking to obtain a new mortgage, we need to see where they're at on the total financial picture.
100%.
And I don't know if you know the number, but how many mortgage professionals are there in the US?
I've heard over 150,000 loan originators.
And how many CDLPs are there in the US?
I think there's about 600. Sorry, Jody, if you're listening, I don't know the exact number, but you can kind of get a clue to the ratio there.
So we're talking 150,000 to 600. So you can see how vital it is to get the right mortgage professional that also has the depth and the breadth of understanding divorce, because your employees need to know where to live and how they're going to live, and where you're going to live is going to, or how you're going to afford to live where you're going to live through divorce, cohabitation. It is the major problem in divorce. Just who's going to keep the house, who's staying, who's going, how are we going to make this work? So, I mean, I am forever running down the hall saying, do you have a minute to talk to this couple? Do you have a minute to talk to this couple? Whether they're mediating here, and our dining room table is now turned into Paulette's mediation conference center. But I can't tell you the difference as a coach and a mediator in bringing his expertise to the conversation. The sooner the better. It alleviates so much anxiety. And what's the best way for someone to find a CDLP? Are they location centric and driven like lending professionals too, or can they work in other areas as a?
Yeah, most CDLPs are licensed per state or maybe multiple states like myself. But the best way is through the Divorce Lending Association, www.divorcelendingassociation.com. There's a member directory, and there you can put your state in, or really by name if you've heard, and you can contact them directly through that website. Mm-hmm. And there's a lot of resources on that website as well for divorcing. You can get a lot of education about really, again, the laws in place as it relates to divorce and financing.
This is so important. And I hope that everybody that's listening today got a chance to see that, gosh, if my employee can get the right lending professional, there's a really good chance we can keep this employee at our company. So Stephen, thank you so much. We're so excited. And I wanted to remind everybody that if you are here and you are a member of SHRM, we have a SHRM half-hour credit for you. We have a link in the chat box for you to get your SHRM credit. So please take a look at that now. And Stephen, if somebody wants to get in touch with you, how do they do that?
Either through the Cdlp, website, the Divorce Lending Association, or my email is stephenrigo@cdlp@gmail.com.
Stephen Rigo at CD. You know what? I'm going to leave that to Paulette. You want to put that one in the chat too? Thank you so much, Stephen, for doing this with us today. I want to remind everybody that next week we will be doing this again. And next week we're going to be bringing in Bonnie Chow. She was the former, she was in HR with top 100 company here in the United States. She's now a recruiter, and she's going to be talking about divorce and hiring and how to maybe retain more of your employees as they go through a divorce process. So join us next Thursday right here on LinkedIn Live. Wherever you guys are watching this is absolutely perfect. So we're so glad that you guys are joining us today. And until next week, we will see you all then. Have a great weekend, everybody. Thank you again, Stephen.
Thank you,
Bye.
Vicki. Bye-bye.
Bye.